Normally, whenever I see topics on social media, whether it's Facebook or blogs, mostly I see people talking on technical analysis. They always talk about Elliot Wave. No doubt, as traders, we always try to forecast where prices are going, and that's how we do our business of trading, forecasting where prices are going. But more importantly, we need to focus on money management. The problem with forecasting where prices are going, it's usually never going to hit our forecast anyway, and our goal is just to generate a profit, not to be right or to prove ourselves as right. Anyway, here's why I believe Elliott wave patterns don't work. First, let's just look at what an Elliott wave pattern is. The Elliott wave was created by Ralph Nelson Elliott back in the 1930s, and he used it with great success, trading stocks in the US market at that time. Uh, Basically, he says that prices moves in the form of waves, and there are smaller price waves inside of bigger price waves, which again are inside bigger price waves. However, he has very strict rules when it comes to labeling these waves. So as you can see, this is wave 1, 2, 3, 4, 5, and retracement wave A, B, C. Also notice that inside, let's say, wave 1, you also have 1, 2, 3, 4, 5. And in wave 2, you also have A, B, C. So you have your retracement waves. These are the smaller price waves inside the bigger price waves. Now, the problem why Elliott wave does not work, there are basically two reasons to that. First, let's discuss. By the way, this picture is sourced from sweglue.com. You can find all the resources in the description down below. These are the resources here. You can check out their website directly, sweglue.com and investopedia.com. Anyway, I've seen a lot of wrong applications when it comes to using peak and trough. When it comes to using the Elliott wave. For example, I've seen somebody posting on Facebook before an Elliott wave pattern where he counted 1, 2, 3, 4, 5. And when it came to the retracement waves, he made it A, B, C, repeated A, B, C, and then another A, B, C, in which case this was his forecast. This method is totally wrong. He did a mistake by counting twice, or actually three times, the retracement wave and having three sets of ABC waves. There is what we call the neo wave pattern, in which case the count of the retracement waves or consolidation pattern goes out all the way to H. But even that is very confusing, and many can't follow the retracement patterns. It is easy to follow the 1 to 5 strong trending movement, but when it comes to retracement, it becomes very difficult. And I was thinking, why bother even counting the waves 1 to 5 and then the ABCs and whatever? Whether you stick to the traditional ABC or the Neo Elliott wave, which is going out to H or even I. There really is no point in doing that, because if you look at the mirror from this upper chart here, it's much simpler to just draw trend lines instead. It's much simpler to just draw trend lines instead. So for example, we can see here there is a trend line that way and another trend going that way. And you can see that just from the basic pattern analysis, traditional technical analysis, you can already have a good trading strategy. What's more is the peak and trough. I like using peak and trough because going back to 1997, long before I even had access to the internet and long before I knew about technical analysis, this was the first thing I was using. So I think peak and trough is a better option to follow and much easier to follow compared to Elliot Wave. Now you can find again resources to peak and trough from Investopedia and other sources, as you can see here. And peak and trough is quite easy to apply. You simply count the higher highs and higher lows, as you can see, for an uptrend, and the lower highs for confirming a downtrend, which only gets confirmed here with the lower low. Otherwise, if these are relatively flat, then these are not new lower lows, which doesn't confirm yet the downtrend. It's only confirmed here. So the peak and trough is much better. Now if you're confused on how to use the peak and trough with the candlesticks or with bar charts, then the simple remedy to it is to use a very small moving average, say maybe a 9-period exponential moving average, and then apply the peak and trough to that moving average. So that's the first reason why Elliot waves don't work. It's because they don't apply the rules of Elliot wave properly, number one. And number two, the reason why Elliot wave don't work is because if you remember in my previous videos, I talked about the ultimate money formula. Call is the cost of living and the quality of life. The 4-in involves first and foremost inflation and investments secondly. So this is basically individual financial health, and you put all individuals together in a society, in a city, in a state, a country, and then you have that country's economy and the factors that also affect the economy, especially in inflation. Add to that people's emotions and expectations. Remember, these are always bound to change on a day-to-day basis. Especially nowadays, we have the internet. In the 1930s, when Elliot was using his Elliot wave pattern, information moved very slowly back then. But nowadays, with the internet, information moves really rapidly, and also there are more people who are exposed to the financial markets. They are more aware. And being more aware, they respond quite quickly. They have their own emotions and expectations as the changes happen. And as the changes happen and they create more changes happen, even here in the main economy, which again leads to more changes in emotions and expectations. For these modern reasons, I feel the Elliot wave don't work, and I strongly recommend using instead peak and trough analysis. Now that's the end of this video. I hope you enjoyed it. Please hit the like and subscribe button. And stay tuned for the BOSS or Tata Boss, where we're gonna be looking at technical analysis and binary option scalping strategies, not looking back in time using a chart and saying we should have bought here and we should have sold there, but instead we'll be moving forward in time. To give you a sneak peek, let me show you what I mean when we're looking at a wave inside a wave. So here you can see I have a 1 hour chart, candlestick, and a 5-minute chart. Remember, the factor should always be at least 1 to 5 minimum, and it shouldn't be more than 1 to 24. So you can use a daily chart and an hourly chart, but you should not use something like a daily chart and a 1-minute chart. That will give you false information and false readings. Anyway, this is just the first premiere of the video series. Hope you enjoyed. Do subscribe and stick around. We'll be taking up technical analysis moving forward using real trades, of course, on a demo account, as I hope you do too. Stay safe. Bye bye.